Welcome to an episode of Singapore Real Estate Explained. My name is Cristiano, and today I'm going to talk about interest rates. So in the previous news dash, Geraldine and Lucas was asking this question: how does interest rate affect our Singapore property market? And I'm here today to answer that. Because in looking at the macro trend, you must understand that our Singapore property market is quite correlated to different factors. Interest rate is a very crucial part of it, which we'll understand a little more by analyzing the trends and data. So without much further ado, let's go. So the first thing is to look into the micro level first. What will happen if interest rate change? In terms of our investment portfolio individually. So we have to understand that interest rate in layman terms equates to the cost of borrowing. So in a very logical sense, when the cost of borrowing increases, means if usually in buying property, we have to leverage, you have to buy with a loan. So when you have a high interest rate environment, the cost of borrowing increases, naturally the profit margin in the investment property decreases. And when the cost of borrowing becomes too high to some extent, it discourages people to even want to purchase property in the first place. So in a general scenario, the demand of real estate investment tend to decrease. So that's what we have been seeing. In fact, the past 1 year, this is one of the key factors where high interest rate environment has caused a reduce in terms of the number of people who are willing to purchase property. But will it cause the price to fall? Later on, we will analyze a little more. And why is that so? So one thing we have to analyze is using an example. We illustrate how a change in interest rate will affect how the cost of borrowing will be different in the scenarios. So first thing first, imagine you're buying a 2 million property, in 2018, and subsequently selling it for 2.3 million. Is it true that we earn $300,000 in profits? So if this is only true, if you're paying a property in full without taking loan, which is almost close to impossible in most cases in Singapore, and in the scenario is when the rental of the property, it covers our monthly interest expense. So it means anything that's generated in terms of the rental, it nets off the interest rate. So what we're looking at right now is only looking at the capital appreciation. But with a high interest environment, what happens? Let's look into a scenario of case study 1. Same property, 2 million. You buy now 2 million at 2018. Loan is 1.5 million. At a 3% interest rate, what will happen is our interest rate will be 3,007. As it says amortization table, where every single amount of mortgage, 6,324, is split into two portions. One is in terms of interest, which is the cost of borrowing, is actually burned and given to the bank. And the other portion will be principal, which you look over here. It actually used to pay down our monthly mortgage. Bit by bit, you can see 1.5 was slowly reduced over time. So you can see at 3,750 per month, this is our cost of borrowing, which will accumulate. And if you break down a little further in terms of the returns, so we have profits. So in terms of profits, we have 300k. But take note, the one key thing that a lot of people may have missed out, especially if you're buying for own stay and just staying there, is that this cost of borrowing or called interest, over 3 years can accumulate to close to $130,000. So in terms of real profit, you take 300k minus 130k, it will be 169k. But the good thing about borrowing is that you can leverage, means your down payment is actually much lower. Instead of 2 million down payment, full cash, you are actually borrowing maybe only 500k of down payment. So that's where return on equity comes in. And that's one way actually, if you really look deeper into real estate investment, it's a very profitable way to give you a higher returns as compared to just paying everything in full cash. But in general, using case study 1, why we're looking at this case study is because this is a 3% environment. So let's take a look what will happen if the interest rate would rise to 5%. So in general, you can see back to this 3%, it'll be 6,003, interest 3,750. But if you look at a borrowing cost of 5%, which is quite rare in Singapore, haven't seen one for a long time. The highest I actually hit, the peak was about 4.1, 4.3%, for residential. But if it rises to 5%, let's see what will happen. So in the case study 2, in a similar situation, you see when the cost of borrowing from 3% rise to 5%, you see the money mortgage for 6,000 plus will rise to 8,000. So this is something that people may not know. People always think that if interest rate were to double, our mortgage were to double. So take note, the amount that double is not the mortgage you're paying per month, it's actually your interest. We can see just now was 3,007, now it's close to a double to 6,002 per month. Okay, and the principal pay down will be lower. Okay, so it take longer time to pay down your mortgage. So the difference in monthly mortgage, you can see, instead of 50% increase from 6,003 to 8,000, and the interest payment will double from 3,007 to 6,002. Okay, so one thing to note is when your cost of borrowing increases, okay, let's take a look at your property investment. You can see a small rise in interest rate, 2%. It also means that the profit, okay, from last now 160 plus K will drop to only 80K. Okay, so you can see this is something that you have to take note, especially if you're buying for own stay and hoping the property will appreciate over time. Because if you were to buy and don't take account for interest rate as a form of calculation, which a lot of investors do make this mistake, especially when it comes to buying a property just to stay or just to rent out a very low rental yield. This is something that we do have to take into account. Okay, so if they were to sell at 2.2 million instead, okay, they have made 20K loss. Okay, so that's why it's even more important to find the right property they can appreciate over time rather than one that is whole and stay there for long term. Okay, so why we are looking at this case, because you can see one thing we can take note from this: when interest rate is high, okay, it went up by a 3-4%, 2% percentage, you can see the profit will drop by half, which is quite a decent amount. And it's something that we do have to take note as investors and to prepare for the worst case scenario. So our investment strategy will be defensive. Okay, but the question is, in terms of general trend, how can we buffer against this increased interest rate? So the exception that we can have over here is two, we should always deploy for our investment so that we can be able to predict for worst case scenario is number one, making sure that our rental property is high rental yield, such that in the case of higher interest rate, they're able to cover the interest payment. Okay, this is something that we use for defensive strategy. And the second thing is, in some cases, people do actually look into new launches, okay, where because of progressive payment, the beauty of it is when you buy a new launch, which is a newly built condo that you have to collect key, you don't have to pay the full mortgage amount. You don't have to pay the full interest amount. So it's over a long period of time, progressive payment. And as the foundation is caught, when the building is built to stages, the interest will increase over time. Okay, the mortgage payment will increase over time. So in fact, for some cases, you buy a new launch this year, for the next 1 year or so, you don't even have to pay your mortgage at all. Okay, so this will help you to ride through the wave of a low interest rate and high interest rate environment. And when the interest rate become low, which I'll share later on, some updated news, which generally look at and share in our news dash, that is when we are able to hedge on this kind of profit margin to have arbitrage to make a difference in terms of profit margins. Okay, so this is something that we can take a look at later on. And next, I think that's something that people are waiting for. How does interest rate affect our property price in Singapore? Okay, so now let's, from a micro sense, like individually, we say that, hey, interest rate will affect my individual investment portfolio. But as I mentioned, if you are looking to a higher rental yield environment or looking into an environment where you don't need to borrow loan for a new property purchase, interest rate actually have very little impact individually. But let's take a look at the macro trends. Okay, when interest rate increase or decrease, how does our property market react to it? Okay, so let's take a look. So one thing to take note is, okay, the Fed have been increasing interest rate for the past 2 years or so. And in fact, there are some cases where they finally say, I want a hot interest rate, about close to a few months ago. And just today, just a few days ago, in fact, they have already tell us, they say that, hey, I'm going to cut interest rate. So let's take a look at how the market react according to that. So one thing to take note is, in terms of Fed interest rate, okay, it has been hitting 5.6 million by year end, which is this year end. Okay, same as projection of 5.6 in June, 5.1 by end of 2024. Okay, that was just announced in around September this year, 2 months ago. Okay, that they will try to remain interest rate high. Okay, and this is something that they hope to achieve a constant at 4.6% in 2024. Okay, but today news, the Fed changed their mind from time to time. Things have changed. We will run through later what will happen. But let's take a look at this thing called the central tendency and the median tendency. Okay, long story short, it's a huge range of data. But the key thing is, why do Fed increase or decrease interest rate? The main reason is to curb inflation. Okay, so when there is high inflation in the entire market where things are getting more and more expensive. So what Fed will do, they will actually increase the interest rate so that it makes things a little more expensive. Business will be find harder to borrow the cost to slow down the price increase. Okay, so people will want to spend as much, okay, in general. So they lower down. So one thing they actually do trace, in fact, two things, is in terms of our GDP growth. If GDP growth is growing steadily, but things are getting way expensive, they will increase interest rate to curb the spending. Okay, and the second thing they look at is also in terms of unemployment rate. If the interest rate environment are high, but unemployment rate is not going too bad, it's like below 5 to 8%, okay, below. Okay, that's something that they will still be more prone towards raising its interest rates. But if the unemployment rate becomes too high, okay, it's become unsustainable, that's when they start to lower interest rate. That's why in some prediction, they even say 5.6 to 5.1. Okay, they'll try to remain as a higher margin in 2023, 2024. Okay, but some projection has started to say 5.6 to 4.6. So once again, this is what the Fed have been doing. But as time goes by, as Fed change, you can see later on, just 2 days ago, that's when the whole market will shift accordingly. Okay, so let's take a look. This is around 4 months ago. So let's take a look what is happening. But before that, let's take a look, how does interest rate correlate to our property price? Okay, this had mentioned in one of our webinars before, but we'll just jump straight into this particular parts with the updated news. So one thing to take note is, if you look at the time, okay, before 2013, so you can see, before 2013, how to read this graph is this color graph at the front. If you see this front solid line, they are basically our property price index, which means it traces our property prices and also our transaction volume. So the higher the index, it also means that the higher the transaction, the higher the price. Okay, and if you take a look at the back, if you zoom in at the back, you can see this faint blue line right over here. Okay, faint blue line right over here, and you will notice that this is actually the Fed interest rates. Okay, so you can see close to 1990s, the Fed interest rate used to hit close to 6 to 6.5%. Okay, now it's about 5+ % today's market. Okay, so what happened is, if you look, okay, so there are two series. One is before 2013 and one is after 2013. So you notice before 2013, you look at the very major correlation. Okay, one relationship you can notice is that whenever the interest rate of Fed drop, okay, from 6% all the way to 3%, half the amount, you see that the property price tends to go high. Okay, it tends to go higher. Okay, it will shoot up very quickly. Okay, then what happened is between the 1995 to close to 2000, there was the interest rate stay at 5%. Okay, but one thing to note is the market did not take too fast to drop. In fact, it took like 3-4 years. And if I understand back then, it wasn't the high interest rate environment that caused the property price to crash rapidly. Okay, it's mainly due to the fact of economic downturn is one, but the key thing is people over leverage. Okay, so back then when interest rate is very, very low, people end up borrowing way beyond their means, especially in Singapore. There was no curbing of like our borrowing power like TDSR we have today. People borrow way beyond, and do this thing called equity term loan, where they cash out the profit. Okay, when the property price rise, they cash out 200k, 300k. Some they use this money to buy cars, buy liabilities, making gotten into deeper debts. And the problem is with that, as the body market rise higher and higher and higher, it's to a point where it becomes too unaffordable. Okay, and people, because they borrowed too much, when the economy went down, they couldn't pay their loan. So in the situation, people over-leverage and keep on borrowing too much. That's the main reason it caused the Asian financial crisis to crash. Which you can actually take a look at our property bubble analysis. I mean, we've done it in a video previously about when to find the right property and what is the right timing to catch. Okay, and if you look at another scenario, very interestingly, okay, if you say that high interest rate will cause property market to crash, we notice that the correlation is not very high. Because if you notice, in the 2000 period over here, when interest rates stay at 5 and hit 6%, one thing to note is the property market after 1998, from 1998 to 2000, property market actually went up by double also. It went up to a peak before SARS came in and start to lower it down. So you can see, in terms of high interest rate environment, even at high interest rate environment, property market can still rise up, which is why there are other factors to really consider rather than just looking at low interest rate. Okay, but one thing we know for sure, okay, which is very, very clear in the past 3 decades, is that when you see the interest rate at 2001 from 6% drop all the way to 1%, we notice that the price, okay, it stays stagnant for a while. When it dropped to 1%, okay, or lower, you can see what happened was that the price start to shoot up within 2 years' time. So suddenly it may lag a little, but generally back then the economy wasn't doing very well also. So interest rate, as I mentioned, is only one small part. Okay, so when interest rate remain low, what happened is the whole economy revived and it subsequently rise up to almost close to 3 times, okay, in terms of property price index to the peak at 2008, which is Lehman Brothers, which once again, the same thing happened when there's no interest rate, people overborrow, over leverage, and there was no measures like TDSR today to curb the borrowing power. And that's when people over leverage and the market crash again. So you can see, even if the high interest rate went up, etc. Okay, but the key thing to take note once again, to see a market crash, interestingly, I don't look at interest rate. High or low doesn't matter because the key thing is if interest rate are high, but then when people are not borrowing or people are very safely leveraged, where they're so over leveraging, borrowing too much, they have a lot of safety net. Even if the interest rate go high, they can still pay their loan every month for the next 2 to 4 years. You can see interest rate environment always go up and down. They hold for 4 to even 10 years, which is what happened to Singapore after 2013. It doesn't matter. Okay, but what I noticed, okay, very clearly is when interest rate environment drops, okay, it happened in 2000, okay, back then in 1993, and another scenario over here, you can see very clearly in 2009, when interest rate dropped from 5 all the way to close to 0% for some time. You can see property market in Singapore is very sensitive to interest rate drop. The price just went up. Okay, so this is a very clear sign when interest rate is cut to a huge margin down, you can see that the property prices just go up. Okay, it's always a very clear sign, especially once it hit the low interest rate environment. Okay, so when is it good to buy? It's usually on the way down, or rather when the interest rate is at the lowest. Okay, so that's when the market will react accordingly to start borrowing and people will start to buy and the price will start to shoot up. Okay, but the key thing is when this happens, seller also want to ask higher price. So it's always knowing when to catch the right angle. Okay, but one thing to take note is after 2013, okay, one very important thing happened, which I explained previously, what caused the bubble to crash in 1997, 2000, and 2008, which I repeated quite a few times in not just webinar and also in my previous video, is because people borrow way beyond their means. So there's no control in terms of what they can borrow, how much they can borrow based on income. But in 2013, what happened is that there's this thing called total debt servicing ratio, where last time maybe 10k income can borrow 2 million, but today 10k income, same age, same background, you can borrow maybe 1.2. So borrowing power is cut. And borrowing power is cut in 2013. Of course, the market slowed down. Okay, that's one very great cooling measure. But it also allowed the market to have a proper re-establishment of equilibrium, where you end up having people being able to hold their property, not over leveraging. And for the past 4 or 5 years, from 2015 to 2018, that was when the market has started to stabilize. So with this, one thing to note is the ideal interest rate in hike. You can see even in 2015 to 2018-19, okay, over here, you notice even with interest rate hiking, the price went up by close to around 9 to 10%. It didn't stop it. Okay, in fact, it had been quite stagnant at some time for about 2-3 quarters when interest rate environment high. But one thing is when you hear interest rate is going down scenario, what happened is that the price shot up almost immediately. So it's one thing we have to keep a lookout, take note, and wait a little longer, because these are things when there is a reversal of interest rate. Okay, it promotes a very fast growth environment from 2019, okay, when interest rate dropped, 2020, all the way to today, 2023, where clients who have bought at this timing, they have caught the right wave. Okay, along with other factors, which we will discuss in other videos. All right. So with this, okay, this is reaching almost the end of the video. So what will happen, okay, in terms of interest rate, when it cut interest rate 4 times next year, okay, economy remains resilient. So you see, it's very nice because they say the economy is not crashing, it is stable. And when this happens, when the interest rate drop, okay, and in fact, in New York, we have heard of realtors have been saying that the price will only get will get higher. It's not because of just about interest rate getting lower, but you must understand one key thing which we have to keep a lookout of is a demand and supply curve in Singapore at this point in time. Okay, same thing in New York. Supply is limited, demand is increasing. Naturally, the price will go up. So for this case, when the interest rate will cut 4 times, let's see how much it will cut. Okay, so they will actually deliver 100 basis points cut in 2024 another 100 basis points in 2025, and more in 2026 to a steady of 2.75 to 3%. And that's something that they mentioned all the way up from 5.6 to 6+%. They're going to cut all the way down. And this is something that we have to take note, because when interest rates are dropping along the way, the market will have a revival. Okay, but it's not so soon. But it also means that in this period of time, when it is on the way of cutting down, especially when you buy a property, it takes about 3 to 6 months to complete a whole purchase. You can actually leverage on this high interest rate environment first, that people are more apprehensive to sell. I mean, they are more negative in terms of the market outlook to capture a good price. Yet at the same time, leverage on this particular trend, because the key thing is when you look at selling, when you look at exiting, it won't be the next 1 year. It will be a 3 years to 5 years hold. That's usually for property because of seller's stamp duty. Okay, so with this, let's take a look at how interest rate will actually react accordingly in terms of one of my good mortgage specialist friend, Unbeatable Mortgage. Okay, he actually came out with this particular prediction. But of course, things may change, because now with the new news, this was actually done about 3 months ago, but with the new news, there may be a cut in the interest rate. This could be lower, in fact. So over here we have the EFFR. Okay, so this is linked to the Federal Reserve rate. In 2023, now it's 5.6%. Okay, and in 2024, okay, it's okay to cut 100 basis points, means 1% down. It could be close to 4.6. But right here, before that, it predicted 5.1. So you can see, as the Fed announced things will change drastically. So that's something that we have to take note about this kind of news. Okay, and he predicted in 2025 will be 3.9. Okay, but over here from 5.6 it dropped to 4.6. And in 2025 it will cut 100 basis points, which is close to another 3.6. So you can see it's actually slightly lower. Right, then after stabilizing 2026, there will be 2.6 to 2.9. So this is about something that did predict correctly in the long term run. So in the longer term run, we buy something in 2024, exit 2027, interest rate environment will be much more favorable, and the prices will tend to be higher later on. Okay. Meanwhile, one thing we have to take note is you can see over here as Sora. Projection 2023 now is 3.93%. Okay, it's about almost 1.7% lower than our Federal Reserve rate. Okay, prediction is 3.6, 2025 2.81, then drop to 2, which is our stabilized interest rate, which is the average interest rate in Singapore in general for the past few decades. So by understanding this, right, the key thing that we have to take note is that a trajectory in terms of interest rate will definitely drop in the next 3 years. So when, as I mentioned, when you enter a high interest rate environment, when people are fearful, you will tend to be able to negotiate and get a better price. But in an environment when interest rates are low, I mean, sellers will know that, hey, now it's easy to borrow. It's more people are coming to buy. There are more competitors in the market. But right now, people say, I mean, interest rate is too high. As you see, some of the first scenario in microanalysis is people tend to say that it's too expensive to borrow. I don't want to borrow. But the problem is later on, when you want to borrow, there's so many competitors. The price you're paying could be 10 to 15%, which actually outbeats the difference in the interest rate that you are buying at. And the beauty is, if you understand a little more, for SORA rates, okay, this is SORA, floating. Okay, floating rate, where you have SORA plus a spread, that will give you your final interest rate. But if you're looking at a low interest rate right now, maybe about 3.1 to 3.2%, for example, for 1 year, next year, you can always go back to a fixed rate. A fixed rate, usually, most of the case, is lower, okay, than your floating rate in general. Okay, unless the interest is so low, then it's a little different. But in general, most of the fixed rate are lower. So next time when you refi 1 year late down the road, it could be another low interest rate at 2.5 to 2.3%. So perhaps when reaching about here in general SORA rate, it could be even 1.5% back to the period of time when there are cases where it was below 1%, but we don't be so optimistic. There's some things that you can hedge against to make this to an advantage when it comes to buying a property. Okay, so we come to the end of this video. Okay, to conclude, okay, interest rate is actually only one part of the real estate investment equation. Okay, so there are many other things that we do have to take note in terms of the macro trends and the micro. And one key thing that we do look very closely to and tracing every single quarter is our supply versus demand curve. And this is something that we do have very close attention to because it has a greater correlation when it comes to our property market price in the short term to mid-term run. Okay, so if you're keen to find out more, okay, do contact our WhatsApp number right here below, which will appear on the screen, and we will get our investment team to reach out to you so they'll be able to value add in your investment journey. And also, if you'd like to find out our recent updates, our news dash, our home tour series, or any good deals that we found in the market, okay, do follow our Telegram channel, it will appear right below, and we're more than happy to share more about all these things to you. Okay, so thank you for watching till the end of this video. My name is Christian, and see you soon. Bye.